Only 5% people in India invest in stock market, and only 3.5% people invest in mutual funds. If you are not a part of that 5%, or if you invest a significantly small portion of your savings into mutual funds, then you might find this video useful. The reason for you not investing in the market can be one or more of the following. Newsfeed on market crashes creates fear and makes stock market investing sound like gambling. Someone known or even you losing money in the market at some point in time. You do not understand the market. And lastly, the unawareness about the massive difference in wealth creation through investing in stock market. Let me decode these fears and unawareness one by one and see if that will help you get into that select 5% of the population. Up on the screen is the yearly performance data of BSE Sensex in last 1 decade. This data tracks the calendar year end return of Sensex over last 10 years. Out of the last 10 years, 5 years have given negative or low returns. They range between -5% to +8%. The remaining 5 years have given positive returns in double digits, ranging from 14% to 28%. Add to it the market crashes during these years, and you get the complete picture of market behavior. 7 out of 10 years saw crashes in double digits, while the remaining 3 crashed in single digits. So all the market crashes that you hear about is real. And these crashes create panic and lead to people exiting the market in a hurry, incurring losses. So the first 2 fears are valid. Markets crash and people do lose money in the short term. With all these fluctuations, it becomes very difficult to understand the market. And that's the best part. You do not need to understand the market. Actually, no one does. This simple act of not trying to understand the market is what insulates you from the ups and downs of the market. So, why should you invest your hard-earned money into something which you do not understand? Look at the same data from a distance and you'll get the answer. A clearer and sharper picture emerges when you look at the same data of Sensex returns over longer time periods. This is what the Sensex has delivered in the long term. Last 5 years, the CAGR has been 14%. Last 10 years, which is this decade, the return has been 12%. The return for this century, that is last 24 years, has been 13%. And the return on Sensex in last 45 years since its inception has been 16%. All of this is in CAGR, meaning average annual return. And then there's another additional component to it. When you reinvest the dividend, all these returns go up by 1 to 2%, taking the returns further up. This is the most passive and safe investment that I'm talking about. This is Sensex return, which means that you are investing in an index comprising of top 30 companies in India at any point in time. And these companies and their returns are fairly stable. Once you start your investment journey, gain confidence, and then venture into active mutual funds in categories like mid-cap, small-cap, flexi-cap, etc., you will realize that getting a 20% annual return in the long term is also a likely possibility with the right funds. So what difference does a 12%, 16% or 20% create on your wealth generation goal? Is it even worth chasing? Let me show you a comparative view of the same. This table shows the growth of 1 lakh rupees of investment at different time periods at different annual rate of return. The 3% that you see is what you get in your savings account. The 8% is what you can potentially earn on your FD, PF, PPF, etc. While the current reality on savings account and FD is lower than this, I have still taken a higher value for comparison. If you are 40 with an investment horizon of 20 years, the difference between 8 and 12% is 5 lakh rupees. While at 20%, the difference goes up to 34 lakhs. At 30 years, the same difference goes up to 20 lakhs in case of 12% return, and more than 2 crores if you look at the return at 20%. All of this is on an investment of 1 lakh rupees only. You make an higher investment, let's say of 10 lakh rupees, and your gains go up by 10 times compared to what you see in the table. If you do this comparison, even for a smaller amount, the difference is substantial. After initial few years in the career, there's always some surplus amount from the salary which continues to accumulate in your savings account. And over the years, it gradually accumulates into a few lakh rupees. Let me show you how an active investment of the same residual amount month on month can create a much higher wealth for you. This data is based on a savings of 5,000 rupees per month. In a time frame of 20 years, the difference between 3% and 12% return. So the difference between what you would get in your savings account versus the average return in mutual fund is 30 lakh rupees. While at 16% it becomes 59 lakhs, and at 20% return it's slightly more than 1 crore rupees. At 30 years, the difference between your accumulation in savings account versus mutual fund investment is even higher. At 12% return, it's 1.25 crores. At 16%, it's about 3.2 crores. And at 20% return, it's a whopping 7.5 crores. All of this on a base of just 5,000 rupees per month. So a simple act of investing the unused residual amount in your savings account can create an additional wealth of a few crores for you, depending on the tenure and the amount that you invest. And this additional amount can reduce a few years from your working life, setting you free much earlier to pursue whatever you desire. So it's high time that you started on your investment journey and stay committed to it for your long-term wealth generation. You can also watch my previous video on where is your money growing fastest to take a stock of your current investments and what is the return that they are generating. This will help you streamline your existing investments as well. Thank you for watching. I'll see you in the next video.